really, really, really dangerous. They're really dangerous. And so often in public forums, when I'll discuss this, I'll be faced with a concerned couple that says, but Mr. Rule, we need the yield. As though their own needs mattered somehow. I'm delighted to say, as a consequence of those three features, the deposit products, the bullion lending, and the IRA, that while we started EverBank with a zero customer backlog, when we roll out Battle Bank nationwide on February 17th, leave an old guy to do what he does well. Go to ruleinvestmentmedia.com. I will grade your natural resource portfolio for free, absolutely for free. Of course, that comes with a money-back guarantee. It's a pretty good offer, and so I encourage people to do that. And I guess that's all the commercials you need. For the average investor, any debt that isn't investment grade, isn't triple B or better, probably any debt that isn't investment grade, and also, no, I wouldn't include publicly traded, because I'm okay with prime rate bank loans, I'm okay with bank loans to, as an example, Exxon. That doesn't bother me.
Mm-hmm.
But the triple C's,
Yeah.
to, Schlepp, Schmuck, and Schmo Automotive, or Red Lobster, people own these ETFs that are agglomerations of sub-investment grade credits. And those credits were established by Wall Street to benefit the issuer and generate a fee. They were not constructed for the benefit of the buyer. The buyers are, in very ugly parlance, yield whores. They chased 50 or 60 basis points or 100 basis points and gave up completely any focus on credit quality.
Yep.
The second concern is, I think, duration. If you believe, like most of your listeners do, that inflation is expressed by the CPI, I think you need to reorganize your thinking. The CPI would have you believe that the underlying rate of deterioration of the purchasing power of the US dollar is 2.7%. Any of your listeners who use their common sense and compare a basket of goods and services that they acquired in 2020 against the price levels of that same basket of goods and services today will understand that 2.6% is fallacious.
Mm-hmm. Besides
which, the index, when it's inconvenient, doesn't include food or fuel. If you could see my total self, you would see that lunch is important to me. So that index is less relevant. And the index also doesn't include tax. Now, I would suggest, Lynette, and I think that your viewers, if they examined it, would agree, that the real underlying rate of deterioration of the US dollar is more like 8%. That's where the problem is. If you are saving in a US 10-year treasury at 4.15 and you're getting paid back in a currency where the purchasing power is declining by 8, there's a negative yield. Where that hits investors is that any long bond they own, any duration longer than 5 years, is exposing them to a negative real yield. And it exposes them to a capital loss if, as in the 1970s, capital markets come to understand that long bonds are destroyers of capital. So the people who are investing in these yield products with sacrificing credit quality for yield and also assuming duration risk, which I think is underpriced,
yes.
Really, really, really dangerous. They're really dangerous. And so often in public forums, when I'll discuss this, I'll be faced with a concerned couple that says, but Mr. Rule, we need the yield. As though their own needs mattered somehow.
High yield bonds sound attractive. Who wouldn't want higher income? But beneath the surface, many of these investments carry significant risk. Debt rated below investment grade, often classified as junk, is being bundled into exchange-traded funds and marketed to everyday investors chasing extra yield. These bonds were frequently structured to benefit issuers and generate fees, not necessarily to protect buyers. Investors often sacrifice credit quality for a small increase in return. In today's environment, that trade-off may prove costly. When risk is misunderstood and liquidity disappears, those safe income products can quickly transform into vehicles of instability and loss.
One of the things I've learned building a new bank, Naked Commercial, is that there are $3 trillion in the U.S. in bank deposits that pay no interest.
Mm-hmm.
Now, why would you take deposit risk and get paid no interest? What are people thinking about when they deposit $3 trillion and don't receive interest? This is an increase in your sense of financial well-being that isn't reliant on the state. It isn't reliant on your employer. It isn't reliant on your customer. All you have to do is switch from a no yield account to a yield account. And yet $3 trillion has forgotten to do this. When I talk to people, I don't know if you know this, Lynette, but I've offered free portfolio evaluations for 35 years, limited to natural resource stocks. I've graded almost 100,000 portfolios. And one of the things that strikes me is how little investors know about the companies that they've invested in.
Mm-hmm.
Maybe the name, maybe the symbol. They certainly know day to day whether they're up or down. But the idea that you make money on the delta between what something is worth and what it sells for is foreign to most people. They pay slavish attention to the price information because it's easy to get, and they pay no attention to the value that's hard to get. That 100-year bond goes right to that. Why on earth would you, in an inflationary environment, I mean, this is what I guess it was Franz Pick used to describe as a certificate of guaranteed confiscation.
Official inflation data suggests moderate price growth. Yet households experience something very different. When comparing everyday expenses, food, fuel, insurance, housing, many families feel a far steeper decline in purchasing power than reported. If real inflation runs closer to 7 to 8%, long-term bonds yielding 4% are not wealth builders. They are wealth destroyers. This creates a dangerous illusion. Investors believe they are earning stable returns, while in reality they are losing ground. Duration risk compounds the problem. The longer the bond maturity, the greater the exposure to rising rates and eroding currency value. In inflationary periods, long bonds historically suffer significant capital losses.
People know me from natural resources,
Mm-hmm.
but this is the 7th bank that I've had a real involvement in. The bank immediately before this was EverBank, which was a fairly popular bank. We were one of the first online banks in the U.S. Enjoyed real success by offering deposit products, particularly non-U.S. dollar deposit products, that Americans had never experienced before. And we grew that bank from 0 to 28B, then sold it to TIAA CREF. TIAA CREF bought it because we had a great platform, and they thought that they could introduce 1.5 million retired teachers to our platform and provide good banking services, which they did. But there was a big difference between the product aspirations of retired teachers and the product aspirations of the aspiring class who were our customers. And so our bank abandoned our customers after we sold it. So rather than retire, I decided to join Frank Trotter and start a bank. By the way, a stupid thing to do if you intend to retire.
I did the same. I didn't start a bank, but yeah, at 69, I started.
Yeah, you get it. So let's talk about what's different with our bank.
Yes.
First of all, although the regulators will tell you that 7% is well capitalized, I prefer some number like 10 or 11. Although a lot of banks report profit trading in derivatives, I don't like unquantifiable risk. Will we hedge interest rates? In other words, will we use derivatives to enhance our balance as opposed to trade in them? Of course. Mm-hmm. Will we trade or guarantee derivatives? Not on your life, not on my life. Deposits. We have, well, to differentiate us from our competitors, the big banks have 15 or 16 deposit products. The only reason that you would do that is to raise your costs or to confuse your customer. Right. We don't want to do either. We have one, a high yield money market account you can write checks against, you can do bill pay, and we pay you interest. It seems to me that people ought to be interested in receiving interest on their savings. The second thing that we'll do for depositors is we won't constrain you to just the US dollar. We will allow you access to FDIC-insured deposit products in 20 currencies. And I believe that's going to come in handy. I believe the next 10 years we'll have plenty of currency volatility. But in particular, if you're a first-generation business person and you live your life in Hong Kong dollars or US dollars or yen and US dollars or euros and US dollars, the ability to bank in both currencies will be important to you. The second feature about our bank that I think your listeners might like, Lynette, is that with Battle Bank, your IRA is actually your IRA. On Wall Street, your IRA is a receptacle for their annuities and ETFs and mutual funds. At Battle Bank, your IRA can own an owner-operated duplex or triplex, or an owner-operated Airbnb. You can own a Subway franchise. You can invest, if you would like, in private partnerships if you're accredited. You can do a whole bunch of things, and you decide. Wall Street doesn't decide. The third benefit of the bank, and this is what's really been responsible for the dramatic increase in interest in the bank, is that we believe that bullion is good collateral. No bank in the U.S. will establish a credit line against physical gold, silver, platinum, or palladium in amounts less than $10 million. At Battle Bank, we believe, first of all, that people that save in gold and silver are prudent people. They're good people to lend to. But we also believe they're good collateral. And so at Battle Bank, you can, if you have gold, silver, platinum, or palladium in your portfolio, you can access that capital through a credit line. You don't even need to borrow the money. You have it available to you if you need it or want it without having to sell your bullion and pay the capital gains tax. I'm delighted to say, as a consequence of those three features, the deposit products, the bullion lending, and the IRA, that while we started EverBank with a zero customer backlog, when we roll out Battle Bank nationwide on February 17th, our customer backlog exceeds 20,000 people.
Which is 20,001, would you, Rick?
Well, I'm all over it, Lynette. We would love to bank you. We would love to bank you, dearly love to bank you. We will not be rolling out to the world on February 17th. We'll be rolling out to the wait list. So if you want to talk to us about those, please go to battlebank.com, get on the wait list, and tell us specifically what products or services on our menu you're interested in, so that we don't make a solicitation to you that wastes your time.
One growing concern is the explosion of high-yield and private credit ETFs. These funds promise instant liquidity. Investors can sell at any time. But the underlying assets are often illiquid junk bonds. If large numbers of investors rush to exit during market stress, fund managers must sell assets that may have few buyers. This mismatch can trigger a modern-style bank run. History offers warnings. During the 2008 crisis, structured credit products collapsed once confidence evaporated. Today's structure could face similar pressure. When liquidity is assumed rather than guaranteed, markets can unravel quickly, catching investors unprepared.
Initially, you will have to be a U.S. citizen or a Canadian citizen. At EverBank, we were ultimately able to service customers in 28 countries. We need to get Battle Bank up and launched in the U.S. before we worry about Australia, New Zealand, and Argentina. What we will be able to do that I think will be of interest to Ronan McMahon subscribers, to the Nomad Capitalist, is we will be able to provide US dollar first mortgages on properties in foreign countries that have title insurance.
Oh, I like that
So
one.
if you were to buy a residence at Rancho Santana, where I just was in Nicaragua, or in Cafayate in Argentina, places that are popular with American and Canadian expats, and you wanted a US dollar first mortgage, provided that there's acceptable title insurance to us, we will provide first mortgage financing to Americans and Canadians on residential real estate domiciled outside of the US.
This is really excellent to know, because I did see a really nice piece of property in Powney. It was perfect.
You just need to make sure that there's title insurance. We want to make sure that your property, Lynette, is actually your property, sometimes unbeknownst to you. And I think what's important for your listeners to understand is not merely that problem, but the fact that the problem's unquantifiable.
Yes.
Given the level of expertise that most people have, I can't understand it. And I've lived my whole life in finance. If I can't understand it, what's the probability that your listeners who have lives, jobs, homes, gardens, grandchildren, books, what's the probability that maybe they have the ability, but do they have the time and the inclination to understand it? Taking unquantifiable risks is not a smart thing to do.
For decades, investors have benefited from declining interest rates and expanding asset prices. That long bull cycle created confidence, perhaps too much. Many investors focus only on price movements, not underlying value. They know what they own is worth today, but not what it truly represents. Speculation has often replaced disciplined investing, yet markets reward understanding over hype. Investment success comes from recognizing the difference between price and intrinsic value. Blind optimism may have worked during years of easy money. In a more volatile era, however, knowledge, caution, and selectivity will matter far more than momentum or popular trends.
First of all, don't come away from this interview thinking that things are hopeless, that what you're going to do is go in the corner, curl up in fetal position and cry. If you don't prepare yourself, you're going to lose. And you don't have to lose. If you're prudent, you'll get through this. It won't be as easy as it's been in the past, but you and your family, and if you're lucky, your friends, will get through this in fairly fine order. How do you do that? Well, first of all, adjust your living standards to your financial standards. You need to save, and you need to save more than you think you're going to save, because the purchasing power of your pension is going to decrease by 75% over 10 years.
If you're lucky.
Don't just save in dollars. I save in gold. And Lynette, I hope the gold price goes down. Yeah, I hope it goes down. I don't think it will, but I hope it does. For me, it's insurance. When you invest in things that you understand, and understand that investment money, not speculative money, investment money is made on the delta between price and value, or price and expected value. Most people's investment strategy is got a hunch, bet a bunch. They
filled with opium.
Yeah, right. And that's worked well for 40 years. It's about to work not so well. I'm not saying don't invest in NVIDIA. I'm saying if you invest in NVIDIA, know the chip business, know NVIDIA, know the competitors. I'm not saying don't invest in technology, although I don't. I'm saying invest in something that you understand well enough that you understand the juxtaposition between price and value. I would also say invest before you speculate. If I had a criticism of most investors, it's that they've ignored investment in favor of speculation. Now, I need to say, that's what I did too. I got extremely lucky. All of the money that I now invest prudently, I made by speculating wildly. But I'm an outlier. I worked hard and I got lucky. Most people aren't willing. Yeah, most people aren't willing to work hard, and they're not going to get lucky. So invest before you speculate. I, of course, am drawn to natural resources because I understand them. I'm drawn to oil and copper, the stuff of humankind, because I know that we've underinvested in it for 30 years. And I know that while demand is increasing, supplies are falling. And I know what happens when the laws of supply and demand intersect. The price response is dramatic. I'm also invested in precious metals because I don't understand the arithmetic of America. I don't understand how we deal with $160 trillion of liability at the federal level. And I think that past is prologue from the 70s. And so I would urge your listeners to consider that too. I hope, and of course, I would urge anybody who's invested in natural resources to submit their natural resource portfolio for me to grade. Go to ruleinvestmentmedia.com, list your natural resource stocks. Please, by the way, no crypto, no tech stocks, no pot stocks. Leave an old guy to do what he does well. Go to ruleinvestmentmedia.com. I will grade your natural resource portfolio for free, absolutely for free. Of course, that comes with a money-back guarantee. It's a pretty good offer, and so I encourage people to do that. And I guess that's all the commercials you need. Consider Battle Bank. Go to ruleinvestmentmedia.com. Invest prudently, however unfun that might be. Save and consider the impact of what I call the arithmetic of America on your lifestyle over the next 10 years.
Amid rising uncertainty, some financial innovators are rethinking banking itself. Higher capital buffers, limited derivative exposure, and simpler deposit products are becoming priorities. Multi-currency banking options reflect expectations of future currency volatility. Another emerging idea, treating physical gold and precious metals as legitimate collateral rather than fringe assets. In a world of expanding government liabilities and unconventional monetary policy, alternative stores of value are gaining renewed attention. Financial resilience may increasingly depend on flexibility, access to liquidity without forced asset sales, diversified currency exposure, and banking systems designed to reduce rather than magnify systemic risk.
We look forward to that, and perhaps our next form of communication is that you should come speak at the Rule Natural Resources Investment Symposium in Boca Raton, Florida, July 6th through 12th.
I would be honored. I would be so honored. So
I think you'd
you're
be
inviting me, I'm saying yes.
I think you'd be hugely amused by some of your fellow speakers, most of whom you will have met before. But the symposium is actually a very good place. Several thousand like-minded people. It's very pleasant. So we can visit offline about how we facilitate that. I'd love to have you down there. And as I say, I think our conference will resonate with your audience. I think you'll resonate with the conference audience. The conference has gone on for 30 years, so we've clearly done something right.
Oh, yeah. Oh, this is I wanted to do your conference, so I am very thrilled that you have invited me, and I will be there.
Great. So perhaps include a link for that too, or if not, we'll do that in a subsequent interview. By the way, for your listeners, the live portion of the conference, that is, if you attend physically in Boca Raton, will sell out in the next month. We have unlimited ability to attend via live stream. I should also tell people that there is an absolute irrevocable money-back guarantee. If you think for any reason that you didn't get your money's worth out of the conference, whether or not you attend live or via live stream, we will, no questions asked, refund your tuition. I'm delighted to say, in terms of live stream last year, we sold 1,400 seats. We had 3 refund requests. So pretty clearly, we fulfilled the market's expectation. But the fact is that it's a riskless transaction financially. If you don't think that we earned your money, we'll give you your money back.
The outlook is not one of despair, but of responsibility. Inflation, debt expansion, and structural financial risks suggest a more challenging decade ahead. Preparation begins with realistic budgeting and higher savings rates. Investors should prioritize assets they understand, focusing on supply-demand fundamentals rather than speculation. Sectors like energy, copper, and essential resources may benefit from long-term underinvestment and rising global demand. Precious metals, meanwhile, serve as financial insurance against currency instability. The message is simple: prudence over panic, preparation over complacency. Those who adapt thoughtfully can navigate volatility successfully and potentially emerge stronger on the other side.